You've been told a lot of things about Social Security. Your coworkers have opinions. Your neighbors swear they know the system inside and out. You've read the headlines, maybe even talked to someone at a Social Security field office. But here's the uncomfortable reality. Much of what most people believe about Social Security is flat out wrong. And those wrong beliefs, they could cost you thousands of dollars in retirement. In this video, I'm going to walk you through the biggest myths people still believe about Social Security, and then I'm going to give you the actual facts backed by the latest numbers so you can make the smartest decision possible with your benefits. Let's get into it. We're going to start with how your benefit is actually calculated, because this is where the confusion runs deepest. Myth number one, your Social Security benefit is based on your final years of work. I hear this one constantly. People genuinely believe that Social Security looks at whatever you earned in the last 5 or 10 years before you filed, and that's what determines your monthly check. So naturally, if you stop working at 58 but don't file until 65, people assume those 7 years of zero income are going to destroy their benefit. That is not how it works, not even close. Social Security calculates your benefit using your top 35 earning years across your entire career, adjusted for wage growth. It doesn't care when those years happened. It doesn't matter if they were at the beginning of your career or at the very end. All that matters is that they're your highest. So imagine somebody who started working at age 22 and earned a strong income for 35 straight years, then completely stopped working at 57. If those 35 years were high enough to max out the payroll tax, that person would still qualify for the maximum benefit at full retirement age. In 2026, that maximum is $4,152 per month, which comes out to just under $50,000 a year. And they'd receive every penny of that, even if they hadn't earned a single dollar in the past decade. Social Security looks at a lifetime of work, not just what happened recently. Myth number two, your early career earnings barely move the needle. A lot of people look back at what they were making in their 20s or 30s and think, that was such a small amount. It can't possibly matter for my Social Security. But this is wrong. And the reason comes down to something most people have never heard of called wage indexing. Social Security doesn't just take your raw earnings from decades ago and plug them into the formula. It adjusts those older earnings upward to reflect how wages have grown nationally since then. Any income earned before the year you turn 60 gets scaled up using something called the average wage index. Here's a real example. Let's say you earned $24,000 back in 1985. That was roughly the median household income at the time, according to the Census Bureau. Today, when you run that through Social Security's wage indexing formula, that $24,000 becomes approximately $99,600. That's the number they actually use in your benefit calculation. So those years when you felt like you weren't making much, they could end up being worth far more than you ever imagined. Myth number three, Social Security pays you back proportionally to what you put in. This sounds logical on the surface. You pay more in, you get more out, dollar for dollar. But Social Security was never designed to work that way. The system is intentionally progressive, which means lower earnings are replaced at a much higher rate than higher earnings. The formula uses 3 replacement tiers. In 2026, the first $1,286 of your average index monthly earnings is replaced at 90%. The next chunk up to $7,749 is replaced at only 32%. And anything above that gets replaced at just 15%. So somebody with modest lifetime earnings might get back 70 to 80% of their working income through Social Security. A middle income earner might see about 40% replaced, and a high earner, maybe 25 to 30%. Those early dollars, those lower earning years, they actually punch well above their weight in this formula. Don't dismiss them. Now let's talk about one of the most debated topics in retirement planning, when you should actually file for benefits. Myth number 4, there's a single best age to claim Social Security. You'll hear people say 62 is the best because you get your money sooner. Others swear by 70 because you get the largest possible check. The truth? There is no universally correct answer. The right age to claim depends entirely on your personal financial picture, your health, your other income sources, and what gives you genuine peace of mind. Maybe you're 62. You're exhausted from decades of work, and locking in a guaranteed income stream lets you breathe. That could be the right call for you. Or maybe you're in great health. You have other savings to draw from, and you want to maximize your monthly check for the long haul. In that case, waiting until 70 makes more sense. Each year you delay past full retirement age, your benefit grows by 8% annually, thanks to delayed retirement credits. That's a guaranteed return you're not going to find in many other places. The point is, no article, no calculator, and no neighbor can tell you the perfect age to file. It has to fit your life. Myth number 5. Social Security is about to go bankrupt, so you should grab what you can. This one causes more panic than almost any other myth, and I understand why. If you believe the whole system was about to collapse, rushing to claim would feel like the only rational move. But here's what's actually happening. According to the latest projections, which factor in the effects of the One Big Beautiful Bill signed in mid-2025, the Social Security Retirement Trust Fund is now expected to run dry around late 2032. That sounds scary, but trust fund depletion does not mean benefits drop to zero. Even after the trust fund is exhausted, workers across the country are still paying into the system through payroll taxes every single paycheck. Those ongoing taxes would still cover roughly 76% of scheduled benefits. So in the absolute worst case, if Congress does nothing, benefits would be reduced by about 24%. That would hurt, no question. But it's a far cry from the $0 that many people fear. And historically, Congress has stepped in before. They did it in 1983, and there are dozens of reform proposals being debated right now. So yes, the system needs attention. But making a fear-based decision to lock in a permanently lower benefit is probably not the answer. Myth number 6. The government looted the Social Security Trust Fund. This one gets people emotional, and understandably so. You've been paying into this system your entire career. But let me be clear. There is no giant vault of cash sitting in Washington with your name on it. There never has been. Since 1983, any surplus Social Security revenue has been invested in interest-bearing U.S. Treasury bonds. The government uses those funds for other obligations, and when the bonds mature, the money gets paid back to the trust fund with interest. That's not theft. That's exactly how the system was designed. Think of it like putting your savings into Treasury bills. Your money isn't just sitting in a vault somewhere. It's being used, and you earn interest on it. That's what the Social Security Trust Fund does with its surplus. Myth number 7. If benefits are withheld because I'm working, that money is gone forever. If you claim Social Security before your full retirement age and you're still earning income, there's something called the earnings test. In 2026, if you're under full retirement age for the entire year, Social Security will withhold $1 in benefits for every $2 you earn above $24,480. But here is what most people miss. That money is not lost. Once you reach your full retirement age, Social Security recalculates your benefit and increases your monthly check going forward to account for every month that was withheld. Think of it as a temporary hold, not a penalty. And once you hit full retirement age, there is no earnings limit at all. You can earn as much as you want with zero impact on your benefits. Myth number 8. If I claimed early at 62, I'm stuck with that lower benefit forever. Not necessarily. Yes, claiming at 62 permanently reduces your benefit compared to what you'd receive at full retirement age. But once you reach full retirement age, you have the option to voluntarily suspend your benefits. During that suspension, Your benefit grows at 8% per year through delayed retirement credits, all the way up to age 70. That means someone who claimed at 62 could potentially boost their benefit by up to 24% by suspending from full retirement age to 70. You're not locked in as tightly as you might think. Myth number 9. Social Security benefits are completely tax-free. This catches a surprising number of retirees off guard. Whether your benefits are taxed depends on your combined income, which the IRS calculates by adding your adjusted gross income, any non-taxable interest, and half of your Social Security benefits. For individuals, if that combined figure lands between $25,000 and $34,000, up to 50% of your benefits could be taxable. Above $34,000, up to 85% could be taxable. For married couples filing jointly, the brackets are $32,000 to $44,000 for the 50% tier and above $44,000 for the 85% tier. These thresholds have never been adjusted for inflation since they were set in the 1980s and 1990s, which means more retirees fall into them every single year. Now, you may have heard that the One Big Beautiful Bill eliminated taxes on Social Security. That's not quite accurate. What it actually created is a new senior deduction of up to $6,000 per person for those 65 and older. That helps lower the tax bill for many retirees, but it does not eliminate the taxation of Social Security entirely. And it's temporary, currently set to expire after 2028. Myth number 10. High earners don't get anything meaningful from Social Security. If you've spent your career maxing out payroll taxes, you might feel like the system doesn't really pay off for someone at your income level. But that's not true. Yes, the replacement rate is lower for high earners, around 25 to 30% compared to 75 or 80% for lower income workers. But the absolute dollar amount is still significant. A max earner collecting at full retirement age in 2026 receives over $4,000 a month. Over a 25 or 30-year retirement, that adds up to well over $1 million in guaranteed inflation-adjusted income. Add in spousal and survivor benefits for a dual high-income household, and we're talking about something that's hard to replicate with any private investment. It's not nothing. It's actually quite meaningful. Myth number 11. My ex-spouse claiming on my record will shrink my benefit. This myth is deeply personal for a lot of people, especially after a difficult divorce. But here's the truth. If your former spouse files for benefits based on your earnings record, it has absolutely zero impact on your own check. Social Security handles these claims completely independently. Your ex doesn't need your permission. They don't even have to tell you they filed, and Social Security won't notify you either. To qualify, your ex needs to have been married to you for at least 10 years, be currently unmarried, and be at least 62. If their own benefit is lower than 50% of yours at full retirement age, they can collect on your record, and none of that touches your benefit by even a single dollar. Myth number 12. If I never had a paying job, Social Security has nothing for me. This one is especially important for people who spent years raising children, caring for family, or supporting a partner's career. Even if you never worked outside the home, you may still qualify for spousal benefits. If you're married to someone who's collecting Social Security, you've been married for at least a year, and you're at least 62 years old, you could receive up to 50% of your spouse's full retirement benefit. And if you're divorced after a marriage that lasted 10 years or more, the same rules apply through ex-spousal benefits. Again, claiming this way has zero impact on your former partner's payments. Social Security was designed to support entire families, not just individual workers. There's a lot of noise out there about Social Security. Some of these myths are harmless misunderstandings, and some of them could genuinely cost you money. The more you understand how the system actually works, the better positioned you are to make a decision that fits your life, your finances, and your future. If this video cleared anything up for you, or if there's a myth I didn't cover that you want me to tackle, drop it in the comments. I put out new content every single week, so if you found this helpful, go ahead and give it a thumbs up. And if you're not subscribed yet, hit that subscribe button so you don't miss the next one. I'll see you in the next video.